Monash University, University of Hyderabad, RMIT University, and IIM Bangalore. His current research primarily focuses on fintech and its applications in democratizing wealth distribution in India through financial empowerment for the bottom of the pyramid population. He has worked extensively on the usage of technology to empower Indian poor households. He is the recipient of several research grants from Ministry of Electronics and IT, the Department of Science and Technology, the Reserve Bank of India, and Ministry of Education, just to mention a few. He has received several best paper awards in the top conferences and published in economics, finance, and accounting A-star journals. In 2023, his work on citizen science pilot using blockchain, IoT, and computer vision technologies made him into the top 100 global innovation pioneers list at the G20 Digital Alliance Summit. Please round up. He received his PhD from Monash University and postdoc from Wharton School of Business, University of Pennsylvania, and Indian School of Business, Hyderabad. So the audience is eagerly waiting to hear you. Thank you so much.
Thank you, Professor Satish, for a very kind introduction. It's always a pleasure to come to ICBF Institute. I have very fond memories of Yashasvi Garu. I used to come here on a regular basis in the early 2000s. In fact, I presented my paper in the first international conference of finance and business back in 2003, if I'm right. That's when the whole thing started, and I got a best paper award at that time. And there were a couple of other conferences where I contributed, and I'm happy today to come here and then give a talk on digital public infrastructure. That's something I'm working on right now, and I thought that could be great for finance researchers going forward. So I'll just give a small introduction to what exactly I'm talking about here. Is there a...
Yes.
Yes. So before we get to, I'll use the word DPI for digital public infrastructure, a short form. So before we discuss about DPI, I'd like to spend about what is the problem which is highly valuable in the world that we are trying to solve, and that can be measured in terms of valuation of companies. So the hypothesis here is that the companies that are highly valued, they're highly valued because they solve a problem that is of great value to all of us, to the humankind. So if you look at the valuation of across the world, the companies, there are only 7 companies that have valuation of more than $1 trillion. Like for example, here is the list of companies that are valued more than $1 trillion. And out of these 7 companies, 6 companies in that list are tech companies. One is an oil company. And out of these 6 companies in the list, 3 are platforms. And the remaining 3 are technologies that support platforms. Like for example, you take NVIDIA. So NVIDIA produces technology that can support artificial intelligence, and that helps platforms to engage with customers in a more conscious way. Right? So, and what is the problem these companies are solving to be valued so high? For example, if you take NVIDIA with a valuation of $3.4 trillion, that's equal to Indian GDP. And they have a staff of 65,000 people working in NVIDIA. Whereas we have 1.4 billion people collectively, we are creating a productivity of the same 3.4 trillion. So why the productivity gains are so high for the company? Why we value that so much? What is the problem to solve? Here's a question I tried to ask a couple of years ago. What makes these companies highly valuable? You see that all platforms solve one common problem. The underlying element of that is trust. So you take the evolution of transactions or sharing of data or sharing of information. So for example, if I go back 600 years in history and see how we used to share information, I'll take example, for example, you want to know what's there in the Bible. And how do you know that? So the only way during those days, because people cannot read and write, they have to go to the church and get to learn from the preacher or the head of the church. or they look at the paintings on the walls and figure out what's there in the Bible. So the data exchange process was very deficient back then. Then we had a huge disruption in terms of having a printing press, for example. So printing press led, to have multiple copies of the same content, and because of that, people had access to information, but they didn't know how to read and write. So they had to go to colleges, and governments have to set up, or kingdoms have to set up universities and libraries and colleges, and that led people to gain more information, more content, more data points. So once you have lots of data points, then again there is a constraint in terms of how far you can monetize this data, right? So because there are limits in terms of how far you can travel to monetize data. Then again, you can think of innovation in terms of, for example, engine as an innovation. So engine led us to travel distances and to monetize data at a higher rate. Still, there is a constraint in terms of with whom you can deal with, how far, what time, etc. All those things. Then we can think of internet as another innovation, right? So internet led us to transact, to exchange, to monetize data with anyone from anywhere in the world at any point of time. So you can have real-time transactions through internet. So when you have a world that is highly networked and transferring data or monetizing data is seamless and highly scalable, then the major problem for us to transact is trust, right? So in other words, I can transact with anyone, but I don't want to transact purely because I don't know them. And I don't know whether that's a good party to transact with. Now you have post-internet platforms, right? So the evolution of Web 2 as an economy, right? Where you create a platform and you create something called a trust model. And the objective of the trust model is to solve a trust problem. For example, you take Amazon. Amazon creates a trust model because the buyers doesn't know the sellers and sellers doesn't know the buyers. And they try to solve the problem by giving a guarantee of return, saying that if you're not happy with the product, you can return it back. No questions asked. Likewise, you have something like Swiggy, right? So I'm hungry, that's a data point of value right now. And they try to monetize that data point by providing a service and trying to solve a trust problem. So on the demand side, the trust problem is, we don't know whether the food is coming from the right location, and we don't know the quality of the food that we get. And on the supply side, the problem is that we don't know whether the person who's ordering has got cash in their bank account, right? And Swiggy solves the problem through an open network by tying up, for example, with Paytm. So by tying up with Paytm, they create trust because Paytm allows them to access information about the bank account. And also they can access it and also auto debit the account whenever the order is made. So from the supply side, they solve the trust problem by providing more transparency to the supplier. And from the demand side, they try to solve the problem by providing tracking service, right? So in other words, the customer can track from where it's coming. And based on that, they can build trust that it's coming from the same location with the order. So this is called as traceability. So the underlying elements of trust are transparency and traceability. So if anyone can provide a service where you have access to information about transparency and traceability, then you can build trust on the model. And you see that all these valuable companies provide that service, which is purely built on the trust model. But trust model is not new to us. It's been there for thousands of years. One of the core institutions that provide trust model is a bank. So in the case of a bank, some people would like to consume now, and some people would like to consume later in the future. So for consumption smoothing, you need an intermediary who knows both parties, but they don't know each other, right? And they can trust the third party because they maintain a ledger book. And that ledger book is a proof that the transaction is happened. And this model has been working for thousands of years. And trust model is a very powerful model. So, but the question about trust model, given that it's very powerful and also very valuable, when companies are valued at trillions of dollars, it means that trust model is highly valuable, and that's a big problem for us to solve. Then most of the benefits of providing this model are private benefits. isn't it? Like, for example, when Amazon provides this model, Amazon gains from it in terms of valuation. But the gains are not distributed democratically in the society. That can create a huge digital divide in the society as well, depending on the power of the one who supplies this data, right? So given that data is the most important asset in this model, right? Who owns the data becomes very crucial in the whole model. For example, you install Alexa at home, and Alexa records your indoor temperatures, right? And the data point belongs to whom? Does it belong to you or to Alexa, right? So morally, ethically, it belongs to you because that's your home. But who monetizes the data point? It's Alexa which monetizes the data point. So trust model is a great model, and trust model solutions are highly valuable in the society. Now, the question is, who should build trust models? Should it be public institutions or private institutions? Historically, it's been private institutions that build trust model. You take a bank. Bank builds mobile banking service. Mobile banking service is a trust model, but it's a private infrastructure they try to invest in and provide a service for their customers. And the customers benefit from that, right? And likewise, Amazon provides it for their customers. Likewise, Uber provides for their customers, right? However, the benefits are not democratic for the society. Hence, I think, the infrastructure that provides trust model makes sense to be more public than private. And that's the idea of my research here. So, is it really good to have a trust model built on public infrastructure or private infrastructure? That's the question I ask. Whether it delivers a democratic distribution, a public model versus a private model. That's where I try to investigate. I've been doing it for the last couple of years as part of my research agenda. Okay, so why it's so important for India? Why we need to focus on public infrastructure, a digital public infrastructure in India more compared to any other part of the world. So last couple of years, I was living in the Netherlands as a professor there. In the Netherlands, it's impossible for me to earn even €1 or €1 without government knowing. Right? At the same time, if there is a crisis, for example, when I was in Netherlands, we had COVID crisis. And the consumption smoothing was so effective during the COVID crisis in Netherlands. So people like auto drivers, they cannot drive the taxi anymore during COVID time due to lockdown. So they got last 2 years average monthly income as their salary throughout the COVID lockdown without them asking even one question or claiming for anything. It was auto credit to their bank accounts. So if we have an economy like that, where distribution is much more effective, then I think public infrastructure, again, may not be required, because private infrastructure is highly monitored there in terms of how the benefits are being distributed to the society. But in a country like India, where, if I just give some demographics in India, let's assume we have 100 people living in India. And out of 100 people, 60 people are farmers, and 40 people are non-farmers. Let's assume collectively we make 100 rupees, right? And out of this 100 rupees, the contribution from 60 people is 16 rupees. And the remaining is from these 40 people. So in other words, productivity gains or contribution to our productivity from 60% of the population is nothing. And why we don't have productivity gains from the 60% of the population? I think that's a major question. One of the reasons why we don't have is they don't have access to few important things that are required to contribute to productivity. Right? So the discussion today is more about what is that access and why public infrastructure is important to provide that access. That's the agenda of my talk. So when we talk about access, we're talking about access to finance, access to credit, and access to insurance. And as for World Bank, this is the definition of financial inclusion. So if someone has access to finance for consumption, in other words, you need access to finance to eat and live. And the second one is access to credit, and you need access to credit to create assets. So that once you create assets, they can generate income and you don't have to rely on access to finance anymore. So in other words, you are empowered by providing access to credit. But providing access to credit doesn't mean that you're sustainable, because your assets may not be good quality assets, or they may not generate revenue that you expect to generate. So you need access to insurance as well. So if I'm covered in terms of access to finance, credit, and insurance, that implies that I have full coverage so that I'm financially included in the society and I can contribute towards productivity in the society because I have assets that can generate revenue. Now, majority of the population before 2010 didn't have access to any one of these resources. And I have done extensive research a couple of years ago by taking 45,000 households who have got access post 2010 in terms of access to finance, access to credit, and access to insurance. And I was able to also capture the transitions in terms of access. And I found that transition from access to finance to credit doesn't really take you out of poverty. And transition or living in having good access to credit doesn't really take you out of poverty. Only having access to insurance, the transition from access to credit to insurance, is when you come out of poverty. Right? So this is a paper that got published in a journal, an economics journal, and that clearly shows that you need access to all the three. Before 2010, we didn't have access even for the first one for majority of the Indian population. So the government took a big exercise in terms of creating public infrastructure, because to provide infrastructure, to provide access, one of the crucial problems is trust. Right? So for example, I want you to have access to finance. And for that, there is a trust problem because I don't know who you are. So the first problem government have to solve is to create identity. Right? So identity came in the form of Aadhaar, for example, 2010. So identity allows you to provide access to finance, but it doesn't mean that you can have access to credit. Just as an identity will not give you access to credit. So to have access to credit, you should have transactions. Like for example, you have CIBIL scores, right? So CIBIL scores provide you access to credit, but CIBIL scores are based on your transaction history, right? So for example, most of you would get an SMS saying that congratulations, you got a pre-approved loan. So you got the pre-approved loan purely based on the transactions that you've had in terms of your consumption, your saving, etc., all those things. And post 2010, most of the digital lending platforms started engaging with the clients without any collateral because they were able to substitute physical collateral with information as the collateral. So to provide access to credit, then you need to gather information. You need to have history of transactions on a digital platform. And that was not possible just for providing Aadhaar. And for that, government came out with a second layer of infrastructure called as UPI. Right? So UPI lets your banks to open up with many other players. So you can have an open banking system where you share information about your customer transactions based on the consent of the customer to a third party fintech company. And the fintech company can engage with you by providing access to credit. Right? And that's the second important access that came because of public infrastructure. So post that doesn't mean that you have access, right? So you don't have access to insurance yet. So to have access to insurance, you should also have a record of your assets and liabilities in a digital form. For example, DigiLocker. So DigiLocker is a public infrastructure where it allows someone who wants to engage with you to check your assets, your liabilities, and all credentials that you want to store and give consent. And that allows insurance companies to engage with you. So in a nutshell, public infrastructure or private infrastructure, they're solving the same problem because the problem is highly valuable to solve, which is a trust problem, right? So the question is, should governments or public institutions invest in this infrastructure, or is it a good idea for private institutions to invest in this infrastructure? I think that's a major question that we have to ask. And a lot of people have lauded Indian government for investing on public infrastructure because that allowed people to become more productive because now they have access to finance, credit, and also insurance, right? So has it really yielded enough results? Now we have many layers of infrastructure. I don't know whether you know something called as Unified Lending Platform. Is a new infrastructure. ONDC is another infrastructure. And you have another infrastructure in the form of CBDC. No, you have central bank digital currency. So all these layers of infrastructure are trying to build something called the trust model. Because trust model is the most important model to solve right now. Because trust model allows people to transact more, engage more with the world, and money multiplies over time, leading to more productivity. Right. So if you look at the India stack is nothing but DPI. So India stack has got some objectives here. One is to increase competition in financial sector between banks and fintech companies, between fintech companies and some other third-party providers, etc. And to take out all the inefficiencies in the system, in terms of providing access. Improve delivery of public service and benefits. So access to finance in the form of direct benefit transfer. You have something called as a Prime Minister Jan Dhan Yojana, for example, or Mudra scheme in terms of access to credit, or Fasal Bima Yojana in terms of access to insurance on the crops, etc. And promote financial inclusion, because financial inclusion is all this access leading to productivity. So the way they try to create public infrastructure to start with is the first one is identity as the first layer, where your presence is not required for transacting. And the second layer in the form of paperless layer. So all your documents, all your bank accounts, or transactions, are verified digitally. You don't need to submit any papers. Then you're building, cashless layer is the one, and documents is the DigiLocker. Then you have consent layer, which government is building now. I don't know, DPDP Act. So DPDP Act is about the privacy, and the government is building for consent layer because this information is owned by the customer. Owners should have the benefits of the information. So when government opened up the first layer of infrastructure, which is Aadhaar, so where there was an identity, that has led to a lot of people having bank accounts. So if you look at the bank accounts, before 2011 or until 2011, only 35% of our population had bank accounts. By the time we came to 2017, more than 80% of the population got bank accounts. So access to finance increased exponentially post-public infrastructure. But the second thing we need to look at is whether access to finance has led to access to credit, because it's a natural consequence. You provide access to finance, and if it doesn't lead to access to credit, it means that people are consuming all the funds and they're not going for clearing assets, right? So, and that's not desirable for the government, because that is a productivity loss. Because you keep on, depositing money in their bank accounts, they consume it, but they're not becoming empowered, and they look for loan waivers, for example. So that's something what government doesn't want to, encourage. But you look at the information post 2011. You see that access to credit from financial institutions has come down. That's not desirable from government's perspective. Does it mean that access to finance did not lead to access to credit? That's a big question for us to ask, right? You look at this. Among all the countries, India has got the highest number of inactive bank accounts, right? So, which means that people have access to credit, access to finance, but they're not using that. They're not active in terms of using that money, right? So is that the reason why access to finance did not lead to access to credit? That's a question we have to ask. Now you look at the growth of finance or access to credit from banking institutions versus digital lending institutions versus I'm trying to compare two graphs here. One graph is talking about number of mobile accounts and number of bank accounts. That's the first graph on the left side. The red color is about number of bank accounts over time. You see that the number of bank accounts over time did not increase significantly during that period, right? So once we opened up, there were many bank accounts. After that, bank accounts in the economy did not go up. But mobile accounts have exponentially increased during the same time. And you look at the lending by financial institutions, again, the red color on the right side. So the lending has remained more or less constant. But lending from digital lending platforms increased exactly like a mirror image of increase in the number of mobile accounts, right? So in other words, access to credit did not stop or reduce post access to finance. It's just that the person who's lending has changed, right? So you look at the access to finance, so access to UPI has led people to transact more on UPI platform compared to traditional banking platforms, right? So in other words, digital platforms for transactions have exponentially increased, and banking was not the beneficiary of this. So the beneficiaries were a lot of other players in the system. Like, this is how a bank looks now in India. So you have banks at the bottom layer of the pyramid. And on top of that, there are so many institutions that work with the banks. So either as a lending partner or a credit access partner or a neo-banking partner. So likewise, or a software service provider partner. So this is the open banking ecosystem. And because of this UPI, we have got this, our public infrastructure, the second layer. Access to credit, in fact, has increased significantly. You see that. Digital lending has grown exponentially during that time, right? So this graph again shows that, and banks are lagging behind in terms of access to credit, whereas lending by digital platforms has increased significantly because of public infrastructure in place. But is that a good thing or a bad thing for the society? Because access to credit with lending institutions, because given digital lending platforms, is costly. Because they take more risk, because their collateral is information, and they charge higher rates of interest compared to the banks. Right. So that's a question we have to ask. I think as a researcher, I think that's an important question to look at. The other concern or the paradox is that, the previous graph showed that UPI or digital transactions have increased exponentially over time. But contrary to our beliefs, because you assume that if more digital transactions happen in the society, the cash transactions would come down because money is limited in the society. But the Reserve Bank statistics show that during the same period, the growth of cash transactions equally increased as high as digital transactions. So it's not like cash did not come out, reduce post UPI or public infrastructure. Cash, in fact, increased. So that's a big question to ask, right? So because you assume that once you have a digital platform, a public infrastructure to transact digitally, and as shown by UPI, we have exponential increase in digital transactions or cash-less transactions. Then how come cash transactions also increase equally in the same period? So this is a question I try to dig deep and see and try to understand why there is this kind of a paradox. You would expect this to happen, right? So one possibility is maybe the society is highly polarized. In other words, there is a clear digital divide. People in the rural economies, they do not use digital transactions. And the people in the urban areas, more and more, they start using digital transactions. For example, I did not use my wallet for the last 2 years. I never had one cash transaction in the last 2 years. Maybe it's not the case if I go down the line, bottom of the pyramid, and see what's happening there. So last year, I was on the field in Odisha, in a remote village, where government announced that they're introducing a scheme called a Subhadra scheme. A Subhadra scheme is a financial inclusion scheme. The only difference is the direct benefit transfer happens to their CBDC wallet. In other words, the beneficiary women farmers or rural farmers, rural women, they have to open a CBDC wallet. Only then you get your direct benefit transfer. And I was there as a field researcher to see what is it the reaction to this kind of government decision. Then the banks have to struggle to find women farmers, who are keen to receive the funds in a wallet, and they have to educate them, and they have to spend a lot of resources to train them how to use e-rupee wallet. And surprisingly, the moment they got all the money in their bank accounts, they went to the ATM to withdraw, right? So, and there were queues on the ATM on Subhadra scheme day, which I think no TV has covered it. So the whole purpose of creating a digital infrastructure to empower women farmers, completely failed, purely because they have no preference towards digital transaction, so they prefer cash. So does it mean that the society will get divided? Because the moment it gets divided, it means that they have no access. And if more and more people use cash, they lose access. They lose access to finance, credit, and also access to insurance. Because you get all this access if you have only digital transactions that are verifiable. So does it lead to a situation where I think whatever we started with at the beginning, that you still have an economy of 100 people where only 40 people contribute to more than 84% of the productivity? So that's the question I try to investigate in my research, which I'll share here. Maybe I'll share this graph here. So here we try to see what happens to banks in terms of collaborations. So we try to divide banks into two groups: banks that have invested heavily on private infrastructure. In other words, they are high infra banks. Like, for example, you take bank like State Bank of India, ICBF Bank, Axis Bank. All these banks have very high infrastructure in place, right? So, in other words, they have invested heavily on private infrastructure for their customers' user experience, right? Whereas the other group are banks that could not afford that kind of infrastructure. So the hypothesis is that so those banks that have less infrastructure, which implies that they also limit access of their customers. In other words, the banking system itself is leading to digital divide, because the customers of those banks cannot access all these resources because they're not digital enough. So we divide banks into two groups as high infra banks and low infra banks, and we try to see which banks gained more from public infrastructure in terms of mobile transactions, in terms of value and the number of transactions. As you can see, we run some kind of difference regressions here, and we see that those banks that have low infrastructure benefit more from public infrastructure compared to banks that have high infrastructure. So in other words, public infrastructure has a value gain or welfare gain in this case, purely because the banks that have low infrastructure benefited more. Indirectly, the customers have benefited more because the customers are taking, are doing more digital transactions post UPI coming to the picture, and that reduces the digital divide for the customers and for the economy as well. Right. So that's a good sign that public infrastructure reduces digital divide in the societies. So then the question is, what is that we should do? In a situation where you have this kind of disparities. So I have some themes for researchers who are attending this conference. These are the future themes that you can look into, and these are important questions, not just in terms of publications, but in terms of impact. And you can contribute to the Indian economy in a big way, because we have this huge demographic dividend story, and this becomes a reality only if people have access to finance, credit, and insurance. The first one, the first theme, I think, which is very critical for all of us, is financial inclusion and democratization. That's something I'm very keen and trying to understand more, right? So impact of public infrastructure on credit for undeserved populations. I think that the scope of research is humongous here. So there could be a lot of questions that we can answer in this area. For example, how DPI reduce frictions in lending for MSMEs? No one has looked at this kind of questions. These are important questions. You have data as well to answer these questions. And how open credit enabling networks led to within penetration of credit, right? And the same question for insurance as well. And what are the gender-based effects in DPI-driven financial access, right? And the second set of questions is about the evolution of digital lending models, right? So the questions could be these aggregated models that we got, are they good for the economy, right? So consent-based aggregation models that you have a lot now, are they really creating welfare? I have a paper recently published in a journal called British Accounting Review, where we look at this consent-based lending. So during COVID time, and we show that the lending apps that came during the COVID time were very harmful for the borrowers because they're very highly fraudulent, and they had welfare loss more compared to welfare gains. Although the whole thing was based on concept, right? So that's a question which is still open to answer. So what is the efficacy of cash flow based lending with UPI? So in other words, can you lend forward looking, not backward looking? Because most of the lending happens, backward looking. You look at the historical transactions, you look at your assets and your history, and then give a loan. Can you look forward? Let's assume you're lending a value chain partner. Say, for example, a farmer is a dairy farmer, right? And dairy farmer gets inputs, and they sell the outputs to the dairy. Now, can you have an agreement with the dairy and input supplier and provide working capital to them by estimating the future cash flows of the farm, right? So, at that kind of financing models in digital lending platforms, because you have information, you can estimate the cash flows much more accurately now. So, can you come up with new models? That's a question. You can run some experiments around it. Interoperability is another big thing. So interoperability led to whole public infrastructure, right? So and competition in payment systems. So interoperability has a decreased competition in the payment systems. For example, the questions that what are the implications of UPI and competition among the digital wallets? You take the digital wallets. Now, if you look at the top 3 wallets, surprisingly, the number 1 wallet is GPay, number 2 is Amazon, number 3 is PhonePe, right? So, is that a good thing to have an economy where you have these huge companies making all digital wallets? So is that a safe thing, or can allow wallets to become much more competitive by providing other services? Can they do banking services? So these are the questions open to all of us. Then privacy is a big area. Given that the data belongs to the customer, like for example, I have 5 crores fixed deposit in a bank account. The data point belongs to whom? That's a big question to answer. So the data point belongs to the customer. Bank can monetize it. Is that a good idea? I think that's something we need to consider. And also behavioral shifts. Is important in the consumer behavior. So are they fine? Like for example, what are the right nudges for women to use CBDC? Because it clearly failed in the pilot. How can we encourage women to use CBDC wallets and not use the bank accounts, right? So because CBDC is a great idea, right? For any currency, there are 3 major features. One is currency is an instrument. Currency is an infrastructure. And currency is something that serves the purpose of the government. Like for example, you take our rupee. Rupee is an instrument. When we say instrument, it has got clear identity. And rupee has to be transacted on an infrastructure. The current infrastructure is banking infrastructure we have, where rupee gets transacted. Or you have informal economy where rupee gets transacted, cash economy. And rupee has to serve the purpose of the government. Whatever is the government policy, it's a monetary policy or a fiscal policy, right? So whatever the government would like to intend, like targeting inflation or growth, etc., rupee has to fulfill those functions. Now, if currency is printed by Reserve Bank, infrastructure is maintained by a bank, a commercial bank, and the purpose of serving the government becomes very difficult because in alignment is very difficult. Whereas you take a CBDC, the instrument is created by Reserve Bank, infrastructure is provided by Reserve Bank. So serving the purpose of the government becomes much more clearly aligned. So from government's perspective, it's great to have a CBDC, right? And it's much cheaper to, in terms of operating cost of the government. But from consumer's perspective, there is no difference. Whether you use UPI or CBDC, I have nothing to gain from it. Then if you have this kind of imbalance, how can you nudge customers to get into CBDC? Because CBDC really helps governments, right? So that's a big challenge for everyone. Can you run some behavioral experiments to see what are the right nudges to use to increase penetration of CBDC? Cross-border payments is another area. Like for example, CBDC government is planning to go for cross-border payments, because cross-border payments are very expensive. Now with all these tariff problems and the geopolitical risk emerging, cross-border payments will become much more expensive because currencies will be much more fluctuating. In a typical cross-border payment transaction, you need an import bank, you need an export bank, you need a correspondent bank, you have to open an escrow account, and you have so many layers of transaction costs at every layer. But if you use a CBDC for cross-border payments, you don't need a correspondent bank, you don't need an escrow account, right? And you don't have to exchange the currency into US dollar, right? So, and these kind of things are very important, but it's not easy to implement. So research is important from that side, theoretically as well. And DPI's impact on financial market deepening, whether it really deepens the markets. Right now, you see the evidence clearly shows that DPI is not really deepening the market. People who are using cash continue using cash, right? And people are using, or urban people who are more savvy in terms of technology, they are increasingly using digital transactions. So, which is not a good sign for all of us. So, how can we increase the deepening of it? Is a question we have to answer, right, from that side. Well, I think that's what I got. Yeah, thank you. Thanks.
So thank you so much. That was a wonderful session, and I hope the audience have learned a lot about the DPI in India and the future research agenda for you. May I request Professor D. Satish to come onto the stage and present a memento to our plenary speaker, please. To save time, we are not opening the session for question and answers. You can have a discussion with the speaker during lunch. And given the paucity of time, kindly proceed to the panel presentations starting now. And we'll try to finish it up by 1:30 and then proceed for lunch. Thank you so much.